A lessee leased a retail store for 5 years. The lessee is required by the contract to make the following payments. A fixed periodic amount of 10,000, payable at the beginning of each year for 5 years. An annual variable payment calculated as 100, multiplied by the Consumer Price Index. The Consumer Price Index was 103 on the commencement date, and it was agreed that these payments will be revised at the end of the second year, by referring to the average Consumer Price Index during the last quarter of the second year. An annual payment of 1% of the yearly sales made from the sales outlet. The lessee's incremental borrowing rate is 8%, and the right-of-use asset is depreciated over the lease term. Figure out the lease liability, and the right-of-use on and after the commencement date. Let us examine what to include in the lease payments for this lease. First, the fixed lease payments of 10,000 payable at the beginning of each year, and these are included in the lease payments. The Consumer Price Index is 103 as of the commencement date as given in the example. The annual variable lease payment is calculated as 100 multiplied by the Consumer Price Index of 103, which gives us 10,300, the variable lease payment. And as we explained in the previous lecture, these payments are included in the lease payments, as they are variable lease payments that are based on an index. The annual variable payment of 1% of sales is a payment based on a variable other than an index or a rate, and therefore is not included in the measurement of the lease payments. Instead, it is charged to the profit and loss in the period these related sales occurred. The lessee's incremental borrowing rate at the commencement date is 8%, and 5 years for the lease term. Insert the years of the lease term, then the annual fixed lease payments, 10,000. The variable lease payment that is based on the Consumer Price Index is 10,300 annually. The total annual lease payment is 20,300. In this column, calculate the present value factors. The example mentioned that the lease payments are made at the beginning of each year, so we will use this formula. And note that, the present value factor for the first payment is 1, because this payment is made on the commencement date, which means that the discount period for this payment is 0. Now, let us calculate the present value for each lease payment. The first lease payment is already paid on the commencement date, because as given in the example, the lease payments are made at the beginning of each year, and the standard defines the lease liability as the present value of the lease payments paid after the commencement date. Lease payments made on or before the commencement date are not included in the lease liability. Therefore, the first lease payment is not included in the calculation of the lease liability. Then the present value for the remaining lease payments. By summing up this column, we get the lease liability on the commencement date. The right-of-use asset includes the initial measurement of the lease liability and the lease payment made on the commencement date, and recall that we did not include that payment in the initial measurement of the lease liability as it was not paid after the commencement date. There are no other components for the right-of-use asset. So this is the carrying amount of the right-of-use asset on the commencement date. And this is the entry to record the lease transaction at the commencement date. Let us proceed to the measurement of the lease liability, and the right-of-use asset after the commencement date. These are the beginning balances of the lease liability and the right-of-use asset. The cash payment for the first year, which was already paid on the commencement date, is not included in the lease amortization schedule. The interest expense for the year is the balance of the lease liability that was outstanding for the whole year, which is the balance of the lease liability at the beginning of the year. less the cash payment made at the beginning of the year. And the difference is multiplied by the lessee's incremental borrowing rate of 8%. The reduction in the lease liability is the cash payment less the interest charge for the year, and this is the balance of the lease liability at the end of the year. Let me fill the remaining years for you quickly. That's it. At the end of the lease term, we have a zero balance for the lease liability. The beginning balance of the right of use is depreciated over the lease term of 5 years. Then the ending balance of the right of use asset for the first year. And here we go. A zero balance for the right of use asset at the end of year 5. Let us continue with our example, and see what happens when the consumer price index changes. Assume that the monthly consumer price index during the second year was as given here in the schedule. Revise the lease payments and make the necessary adjustments to the lease liability and the right of use asset. Here, there is a change in the consumer price index after the commencement date of the lease, and as mentioned in the example, the variable lease payment based on that index shall be revised by the end of second year. So, here is the fixed lease payment, 10,000. And this is the average consumer price index for the last 3 months of the second year. And this is the revised variable payment. Then the lessee's incremental borrowing rate, and the lease term. Now, let us calculate the revised lease liability at the end of the second year, and it will be the present value of the remaining 3 lease payments. So here is the number of discount periods starting from the third year. And the fixed lease payment, 10,000. The revised variable lease payment, 11,137. The total lease payment is 21,137 that will be made starting from the third year. Here are the present value factors using this formula because the payments are made at the beginning of the year. And finally the present value of the remaining lease payments, which is the new carrying amount of the lease liability at the end of the second year. By how much should we adjust the balances of the lease liability and the right of use asset at the end of the second year? The balance of the lease liability was 56,500. The revised balance is 58,830. So, we need to make an adjustment to increase the book balance of the lease liability by 2,329. The balance of the right of use asset was 52,522. Add the same figure for the adjustment done to the lease liability, to the balance of the right of use asset. And here is the new carrying amount for the right of use at the end of the second year. The journal entry to be made in the lessee's books at the end of the second year, to reflect the revision of the right of use and the lease liability is: debit the right of use asset by 2,329, and credit the lease liability by the same figure. Now to the lease amortization schedule. Insert the revised balances at the end of the second year for the lease liability and the right of use asset. And here is the revised variable lease payment for the remaining 3 years. The interest charge is the difference between the beginning lease liability and the lease payment paid at the beginning of the year, multiplied by 8%. The reduction in the lease liability then the ending balance of the lease liability for the third year. By completing the schedule, we reach a zero balance for the lease liability at the end of the fifth year. Now let us turn to the right-of-use asset. This is the revised depreciation charge, which is the revised balance for the right-of-use asset divided by the remaining 3 years in the lease term. That's it, zero balance for the right-of-use asset at the end of the lease term. Another example. Please check the following lecture.